and kind of figure out who we're talking to and all. So we're going to do a quick couple of polls. I hope this kind of play along. We'll do some some ways that we can figure out who we're dealing with. So here, check that out. There's a poll there. Just quickly fill that out, and we'll know who we're dealing with. A couple other things I want to talk about, and then also ask you a couple more questions. We'll close this in a second. But so far we have about 88% of the people do stocks and 33% mutual funds. About 50% do ETFs. Some people do currencies. About 30% of people do currencies. So basically we're talking, stocks and ETFs, which is what I pretty much figured would be the case with this. Okay, that's good. So totally we're really dealing with stocks and ETFs, which is really good because that's where the sweet spot for finding where the professional traders are trading and how the traders are working. Obviously, there's options in there also. It's a little bit of a different game that is out there. So, all right. So far, so good. So we have that. While we're at it, also, I want to ask you another question. And just give me an idea. A lot of people may or may not, but do you sometimes kind of get into a trade and you get spooked out of it, or all of a sudden you're kind of short something and it moves against you, and there you go. You're just I can't take this anymore, or you're in a long, and then all of a sudden it just drops down on you, and you're like, oh my God, forget this. What am I going to do? Well, so far we have about 50% of people voting, and about 75% of people get stopped out and scared and nervous and all that. And 25% of the people don't. So got a couple more people voting here. So it's about 75-25. Looks like it's going to be a thing. So that's what I probably would expect. Emotions play a really important role in all of this. But unfortunately, as anybody has heard me talk before, you need to take your emotions and check them at the door. And even though it's your hard-earned money, and even though this is something that you want to make sure that you hold on to, there's ways to manage your money, manage your portfolio, manage your positions without actually getting as scared. If you have a plan, you have to play by rules. A lot of times investors don't play by rules. What they end up doing is they kind of go into something because they heard a tip, or they just look at what is out there in terms of what looks good, or maybe I like Starbucks coffee, or I hate Starbucks coffee. So that's what we're going to go through. So let's kind of start with this discussion. All right. So we're going to talk about. I'm going to introduce you in this particular webinar. We're going to introduce you to a few things. The alerts. We're going to do breaking ups, breaking downs. When a stock is breaking out of a range, how do you know? How do you figure that out? When something is bouncing. So in other words, when you get spooked out, how many times, think about this, how many times you get spooked out and then all of a sudden the thing turns around and it's off to the races and you're like, oh man, and then you don't go back to it. Kind of a bounce situation, we call it. So the goals of this, and the concept is these alerts that we have, is to eliminate one side of the trade. Basically, we want to say, okay, should we be long, should we be short, or should we be nowhere near this thing to begin with? If we can do that, first of all, our entry is a lot easier because we know where we should possibly enter, and it will hold us in that position through a variety of market conditions. So if all of a sudden you get a situation where markets come down, the stock's down, but then you're like, well, I'm getting out because I'm either losing money or I want to keep my money and I don't know what to do. Maybe it's not near any of the traditional metrics that you use, like a moving average or a MACD. We'll talk about that. What we want to really do here is give you the opportunity to have the most reward you can have, and of course at the same time limit your downside. So we can create what's called a defined support. And the defined support, we're going to go through some of the quote-unquote old school ideas and how that happens, and some of the new school ideas, and the ways that you can actually see transparently, in a way, kind of an X-ray vision of what the professionals are doing. Wouldn't it be great to understand how the professionals are trading, where they're actually adding to positions, where they're actually going in short, where they're selling? So that's what we want to do. And in our mind, basically what we think is that we want to find these actionable ideas, these things that are immediately available and basically reliable. I mean, what else can we really ask for there, right? So we're going to start out with some charts. Now what you're looking at is, we just picked JCPenney. JCPenney, this is a standard candle chart that you've seen before. It doesn't give you a lot of information other than the price action. You see some real big gaps. You see some drops. You see where do you enter this? I don't know. Where do you exit it? I don't know. If you're a long-term holder, you just keep it forever, I guess. But here's the thing. Here's a few of the things we look at. So, for example, you may want to look at a trend line. You could draw a trend line. A simple trend line is defined as connecting three or more, let's say, down levels, three or more lows on an upward slant, and that will be a defined up trend line. Because if it holds the trend line over time, what happens is you can feel comfortable. At least that's what the thinking is. So you have this trend line, and okay, so we see a couple of different times that maybe this was a place that you could actually look at buying. There's another trend line, maybe a shorter term trend line. Here's another one to the right. And over here, when we look at this on the right-hand side, over this area over here, this trend line right here, when you look at this trend line, this is, again, connecting 3 points, these points, and when it breaks that trend line on the downside, right about here, right here, what happens is that traditionally could be a signal to get long. This trend line, this longer trend line, is a long-term trend line, so it would have held you in. But is that really the best way to do things? That's a big question. Let's take a look at the next level. So, again, here, where we have the green circle, that was one place that you may want to get long. Here's another one you could have said, okay, there's a place that it broke the trend line, that long term I'll get short or I'll sell. And then all of a sudden here, what happens here is a real problem. Because what happens here is you say, wow, it broke that down trend line, what do I do next? Well, I'm going to go long. But now you're trapped because there's no longer any reasonable trend line to follow. Right there, you're trapped. The longs are trapped inside that trade. All right, now let's go next step. Now we're going to add some volume, a volume overlay. That gives us more of an idea of what's happening. We can see what happens over here. We have basically a high volume spike, and obviously that could have been signaled that institutional investors are getting more excited about it. See another one here, not as big, but it was a down day, but that signals maybe that some people are selling. And here was a huge day, and obviously we saw that giant gap up on that day in late January. And again, this is another way to look at it. So when we look at these situations, now we have to combine a few things. Volume is very important here. I want you to really key in on this. Volume is very important. Let's go next stage. Let's look at moving averages. A lot of people use moving averages. Okay, so what we have here is a variety. We have a 50-day. We have a 200-day. And what we say is, hey, when the stock breaks the 50-day and it moves to the upside, that's a really bullish indication because a lot of hedge fund managers and mutual fund managers really want to look at when it holds above its 50-day moving average. That's a very important level. 50-day moving average, 200-day moving average, very important. So this could be a buy signal here or at least a position to hold you in. Same thing here. You break down your 50-day moving average, and what happens there is that all of a sudden that can create a sell signal. Well, let's continue on. We have some mixed signals here. Look at these situations. These situations here, we broke down on the first one. When you look at the first actual, right here, we look right there, right? So what happens is it breaks down, and it goes through the 50, so you sell. But, whoa, wait a minute. Then you get a buy signal. So you're kind of like whipped around in and out. Over here, we have the same kind of situation going on. We have it going up to the 50. Oh, it's going to break through, and then it doesn't. So, you have kind of mixed signals along the way here that you really need to take a look at. And these aren't the most, in my opinion, the best ways to really play the game. What you want to do is add some things here. Let me erase this marker here. Hang on. Okay. You want to use some mixed indicators, but again, there's other ones to look at, like the Bollinger Bands. So take a look at this. These are Bollinger Bands. And what we have here is, follow my little spotlight here. This is the 20-day moving average, the green, 20-day moving average, okay? And these outer bands are 2 standard deviations from that. And when they get really wide, you have a lot of volatility. You can see that here. When they get really thin, or let's call it here, when they're starting to pinch, that's when there could be a turning situation happening, or when volatility really starts to compress. But again, the same thing is true with this situation, is that it's too many signals. Do you sell, for example, when it goes above its Bollinger Band? Well, if you did so right here, one above its Bollinger Band right there, you would have missed out on all sorts of possible further upside. And at the same time, now you have all these moving averages and all these things going on. So it just becomes too complicated. Then you start mixing up like the MACD, moving average convergence divergence indicator. A lot of people like this because it's kind of easy to look at. So let's take a look at some situations here. So the MACD on this line and this area crossed up from below, and that would be considered generally a buy signal. But if you look at what happened, it kind of just drooped right back down, so it was kind of a false buy signal at that point. Look over here. We saw it cross down. Now, if you would have been in that situation, looking further up the chart, out the chart a few days later, you'd be much better off, or a few weeks later, you'd be better off at this point. But again, did it give you a really good signal? I don't think so. I really don't. And look at this one here. This one did a pretty good job. That was a good job of showing where the downside is in the cross down. So that did work. But again, do we want to have indicators and signals that kind of work, sometimes work, and what happens? And this one right here showed you a variety, all three of these showed you a variety of potential buy signals that were very, quote unquote, oversold, from oversold situations that worked out terribly. You'd have been in at 33, 32, and then look what happened. It didn't really give you anything there to go by. Now, this is something that you haven't seen before, or you may have seen this before. If you actually are a subscriber to TriggerPoint Research and our alerts, you've seen this before. This is probably something you're like, what is that? Well, we're going to get a little bit more in depth into this, but basically what this is showing you, this is an algorithm that is created based on a couple of things. Number one, key support areas combined with significant volume and a calculation to see where the range is from a volatility standpoint that will give you very good indications of when you can actually enter a position. Again, eliminate a side. I want to be in long. I want to be in short. I don't want to be in at all. And on top of that, what it is basically the culmination of what's called a market profile. Volume at time, volume at price. What this does is it's giving us our volume that we saw on that last slide flipped in a different way, which I'm going to show you in a second. And what that does is it gives you a much better indication of where the actual trades are occurring. Where's the real volume inside of any particular swing area? So let me give a little more depth into this. Again, I like to keep things kind of simple because, when you start getting questionable levels, indicators, whether it's an oscillator or a trending indicator, whether it's an RSI, MACD, an ultimate oscillator, whatever it is, there's questions. But we want to define the actual level of support. We want to actually define where is that resistance and where can I actually, quote unquote, buy safely. Now, when you have a wide box, for example, so let's take a look at where that would be. Let's take a look at this area here, right here. See that? And when you go from here, from the green is what we call the low support, high resistance. Look how wide that box is, the big box across there, as compared to, let's say, how thin these are over here. Or the difference between this and the range here from the green, and I'll explain all these in a second, the green all the way to the red. Very wide. Okay, that's about a 12% range right there. Now, when we look at this, one of the major issues that we want to really focus in on is, again, when should I be in and when should I be out? And I don't want to be emotional about worrying about it, did I make the right decision or not? Okay? The question is the price inside or outside of a box? When it's inside of a box, like we talk about, for example, over here, this area here. See, it's inside the box. Inside the box, right here, and it moved out. Inside the box here. Outside the box, right? It's below the green there, see that? When it's outside the box like this, it means, and it's below the green, which is the support level or the resistance on the upside, it is, quote unquote, not a time to be long. Do not be long here. Okay? On the other hand, for example, let's take a look at something. Here, went outside the box and went, but do not be short here. So now we just eliminated two sides, right? One is do not be long, do not be short. You don't have to be in the trade, but do not be one or the other because you can get really smacked hard. There's very little resistance. There's very little volume up to that point. Traders are going to squeeze the shorts at that point, and you're not going to have the opportunity to really have any kind of resistance points. It also keeps you in the trade. For example, if you were to use this is what we would call a bounce trade. When we're inside of a box, comes down to a level of a support that we have identified as very key high volume support. We could have taken this as a bounce trade and stayed in the trade all the way because we stayed inside of a box here. We didn't go outside of a box. We're long, stayed up here, maybe stayed here too, stayed here, didn't go outside of a box, and then caught this whole ride up. Versus the volatility scaring us out somewhere down here with traditional support measures. All right, so we got that. Let me erase this. Now, we're going to get more complex here. All right, now, let's take a look at this. What is this? This is the same diagram, but with more detail. This is very important to look at. These particular areas that we're looking at here are volume at price and volume at time. But we're going to look at volume at price. How much volume has been put in at any given price? Now, we could look at the traditional measures where we see the volume on the bottom, but that doesn't tell us the accumulated volume. Here is showing us the accumulated volume. So, for example, when we look at the blue areas and we look at the actual levels, we say a blue area is a very thinly traded, and depending on how thick it is, the density. But a blue area is a thinly traded area that really doesn't have a lot of volume. It indicates there's not a lot of people trading there. There's not a lot of support, there's not a lot of resistance, and that could be what we call a fast zone, a very, very fast zone. We want to find those fast zones that are above or below one of these ranges, and that can give us some great opportunity. And you can see almost, if you could see through, let me kind of show you something. This is really interesting. Take a look at something. Take a look at right here, this level right here. I'll call it 34, right here. Well, isn't it interesting that before, if we were to say, don't look beyond here, don't look beyond this point here, there's no resistance levels up here. See, there's nothing. It's all blue and all that. So when it kind of gets, look how fast it moves when it gets above this level, above the reds, whoom, moves really quickly. We can see that there's an opportunity to trade there. And look how the support comes right to the line, and then when it had the opportunity to move, it moved very fast. Now, at the same time, look at this new swing that we created here with volume at time. Over this time period, new swing trade time period, look how fast this moved, the swiftness this moved through this zone here. Look how it starts to consolidate. You see that? Consolidate, 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 consolidate. When it moved below this level, look what happened. There's nothing here. Look at this area right here. It's a giant hole. You see that? Giant hole. So what happens is that these are areas of very low volume, very low conviction, very high potential for no support or no resistance. And when you have a stock, for example, that has a high short interest and you have limited resistance, when you start breaking above a certain point, you watch out. You may see an incredible amount of movement to the upside. That's what we want, right? We want some really good moving positions that aren't just stagnating. Grab it where we can find a fast-moving zone. See those? Those are the zones. Fast-moving zones identified. Point is, again, this is very important. When do you want to be in the trade? When do you not want to be in the trade? Assuming you're going to be trading, not just buying and holding. If you buy and hold, who cares? Right? I mean, if you buy and hold, it doesn't matter any of this. If your time horizon is like Buffett and it's forever, well, so what? But those of you, 75%, who say that you get scared out of a trade, wouldn't it be great to have some real solid rules with some very good points that you can see that, you know what, these are not your traditional moving averages that are identified very, very clearly, and prices that are identified very, very clearly, that you can feel good about holding on to a position versus getting scared. Because I'm telling you, I know that those of you that get scared out of positions oftentimes realize that you were wrong to do so right after or soon after that trade closes. All right. So we're taking a look at this again. And one of the big issues here is we created something. Now, there's all these indicators out there, right? The MACD, the ultimate oscillator, there's things called trending and trending indicators and oscillating indicators. There's things like the RSI, breaking above the 50-day, below the 50-day. Now, wouldn't it be kind of cool if you could take all those in a way and put them together? The best of all of them, the best of all the signals, instead of just relying on one. And then create an oscillator around that. So you're kind of like smoothing it out by creating a further smoothing mechanism on all the indicators. So there's about 10 different indicators here. This is on the bottom part of the chart here. This is a proprietary scoring system that we have because we want to have not only an indication of what the stock, where the fast zones are, but we want confirmation that it's actually moving in the right direction. So basically what we're looking at here is when it's red, we're saying that it's in, potentially downtrend in an area that you may not want to get involved until it starts moving on the upside. And depending on how red it is and how deep the red is how bad the correction is. So let's take a look at this. We're going to look at some of the extreme levels. Okay? That's what we want to look at. So there you have it, the same chart again, a little bit longer time period here, with the S&P 500. Now, what we have on the top is a combination of the 50-day moving average, which is the dotted line. We have the 150-day moving average. We have those areas of support and resistance that we have that algorithm that we created for. We have now the T-score, our proprietary, on the bottom. And we have something called Navigator. That's another indication of trend and turning points. That's what we want to find, turning points. Now, check this out. This is what's really cool about this when you combine this. Take a look at this area right here. You see that the first thing we noticed is very clear, right? The first thing we notice is that the price breaks down. It's also breaking down through its 50-day, and it's 150 at that point, back in July. We notice it broke down below a key low support point, where there's no volume to be found. It's outside of a box. So that's, okay, check number one. Then we want to look at, okay, what else? We have confirmation. Where do we find it? Well, we find it on our Navigator. Look at that, rolling over. It was a very, very, it wasn't a very big upswing. We could see that. It was a very narrow level. So we know that it's not the greatest uptrend right here. And it turns. That's what we call Navigator. Then our final confirmation shows us that it broke down, just to keep it simple, went below zero. And we have confirmation that either get out or short. Now, watch this. That's the exact point. Now, wouldn't you feel good if you had the opportunity to actually, get a confirmation like that? Now, it's not always exactly, this is pretty clean, this one, but it's not always exact like that. But at least you have 3 points of confirmation. One, you're breaking down below a support point, so it can move very quickly. And again, this support point is not just a line drawn, but it's a calculation. 2, you know that the trend is definitely changing. And 3, you know that the calculation of all the major indicators, and we mix them up a couple different ways, are confirming that. Here's another one. Could you buy here? Maybe, maybe not. But check a look at that. Triple confirmation of a potential, an area to buy. And what's more important is, if you look to the right of that, we stayed green. We stayed above boxes. We didn't break down. And it would have held you in from, let's say, I don't know, from January or, in the beginning of that. And then, back in May, you broke down again, very similar look, and you had confirmation twice. You had an early warning, by the way, that something was not right. You had an early warning here that something was just, not going right, and you see this trend moving lowers, and starting to, you may be faked out a few times otherwise, but you're below the box here. Something's not right. You're below support. You took a nice little ride up there, but it was very shallow on the uptrend here, very shallow here. And then you broke down hard. Right now, why are we seeing all the volatility? We're seeing the volatility because we're inside a relatively wide box here, by the way. We're holding support, close to about 1,300 on the S&P, right about 1,300. And what we also do is, by the way, we look backwards. we can see other support areas, like when we see matching support areas right about here. So we know that about 1395 and then about 1350 is where there's some support there. But again, you had confirmation. Right now, you could be short, you could be long, but probably there's not a, you're going to see a lot of bouncing around. And what you've seen is a lot of bounce to support, back up, bounce to support, back up. Until you break out of this level up here, which is probably about 1340, and you got a good line of resistance there, by the way. 1345. The fact of the matter is that, you got to be very careful. All right, moving along. So, a couple of things. We're going to answer some questions in a second. I wanted to, let me go backwards here. Let me go back. I moved too fast. All right, let's go back to this for a second. Okay, now, there is one of the major points here that I want to bring out is that we talk about we don't want to be more outside of a box. If it is on the upside, we can be long and stay long. On the downside, if we're below the box, we do not want to be long. We can be short. In a box, there's going to be volatility, and you could do like a bounce trade. You can buy on the bottom and sell on the top, buy on the bottom, sell on the top, short on the top, cover on the bottom. Theoretically, it will bounce through there until it breaks out in one direction. Then you have confirmation. So let me just restate this because there's a question about not to buy or sell when outside the box. When you're outside the box to the upside, above the red line here, above the red line, and again, confirming above the red line, you do not want to be short. The opportunity to be squeezed on the short is a problem. On the downside, if you're below the green, you don't want to be long. Now, there's also a turquoise line there. You see that, the blue line? The blue line is important because that is what we call the high volume area within the actual box. Now, when you have a high volume area within a box like this, you can look at that as good support if you're going to see it coming down to that. If it breaks below that, you need to be very careful because now all of a sudden you just have, you have a top line, a ceiling in a way. So again, depending on the width of the box, depends on the volatility. The actual distance it's traveling, how long the box has been in place, is also an issue. But majorly what you want to do is, if you are above a box, you do not want to be short. If you're below a box, you do not want to be long. You can choose to be long or to be short if you have confirmation across things like we're showing you here on the navigator and the T-score. But the bottom line is that you want to have the greatest opportunity to grab some real good upside potential. There's another question that came in about, are these DeMark indicators? These are not DeMark indicators, no. No, not even close. DeMark does a counting base. He counts, there's a variety of different indicators he uses, but a lot of people use lines to make it simple. But to answer your question, no, these are not DeMark indicators. What we want to do in trading on a technical basis, we're not talking about fundamentals here right now. We're talking about technicals. We're talking about price action. We want to find where the fastest zones are, get confirmation, and be able to stay within a trade as long as possible. I think that's what you'd want to do too. So what you want to do is look at something called a market profile. You can get these on certain, well, you can't get our algorithms, but you can get things like a market profile on TradeStation. They may call it a little something differently. They put it on the side. Inside of a variety of different stock charts has a similar thing. It's a little bit different, but it gives you a horizontal, or it shifts the volume onto an axis, so you can see what's happening over the length of the time. But basically, the point here is that what we think was, came up with a good mousetrap here is that, when you have the opportunity to be in a trade and there's a question, to have a better opportunity to either short or long, and then to, again, stay with it until it breaks, because it may not work. Something else can happen. Stock can be bought out, and it can go up. Stock all of a sudden comes out with a bad earnings number, and it goes down. But at least you know what the point is that you want to hold it until. So if you're at a point that you bought at 35, and you know that the low resistance that we have based on a very hardcore volume, where there's been a lot of buying, is 32, well, it may drop down to that, but instead of you getting spooked out and taking it out at 33 because it dropped 5% or some arbitrary number that you use as a sell stop, what you have is a much better tool here. What we do with alerts is that, with our alerts process, by the way, is for those of you, a lot of you may have checked it out, maybe not, we actually find where there is quantifiable fast zones that are confirmed. On the upside, we like to see a lot of short interest, so it gets squeezed. On the downside, we want to see where there is definitely some little support on the downside, and that gives us a much better idea. Let me show you what an actual alert looks like. Let's see here. Let me bring this up on my screen. Hang on. I can only find it. Hang on one second. We'll get it. All right, hang on. We'll find it. Let me just get this here. Somewhere here. All right, let me bring up an actual alert for you. Just hold on. You got a blank screen right now. We're going to go to TriggerPointResearch.com. I'm going to show it to you in a second here. Just confirm that you can. Okay, we can see that. Good. All right. Now, when you go to the site, there's some things that you can see, some things you can't. I'm going to type in Westport Innovations, WPRT. And we should be able to see this. Okay, so this is what actually happens. So let me just show you what happens when it's live. I'll wait till this comes up on your screen here. All right. So this is something we sent out to our subscribers last week. Sometimes we have, if you follow us at TriggerTrading.com, you go over to Twitter. It's www.twitter.com/TriggerTrading. We'll push that through to you. .com. Yeah, that's good. So if you can follow that. We pass through sometimes some freebies and some things that you may want to take a look at. But basically, the bottom line here is that when we look at a stock, I want to show you the example of what a actual trigger alert actually happens. Okay, so this came out right here, so you can see it right here when it came out. Okay, so we sent this out. This actually goes out via email and text message, and it's on the website, so you can have a history of it. So we say, okay, for a little bit, what the company does, and then what we do is we kind of tell you, okay, here is the here's the kind of right. Oops, oh boy, that's sloppy. This area right here, that just disappeared. Okay, this area right here tells you a bit about, okay, what's happening. It's breaking above its high, and it bounced off major support at about 22, and all that's going on. Then what we do is we say, okay, well, great, that's some information about it. Where's your actual profit that we're looking for? Where's your stop? And here's the actual chart. Now, if you take a look at this particular chart right here, you have the same situation. You have those boxes again, right? Keep it clean, keep it easy. This is just the easy way to look at it, all right? So Westport Innovations, we had it was about, I guess, 28 at the time, something right around there. And this is a couple of days ago. It went up about 3% since then. This is a recent one. You said, okay, here's your profit up to 35, and we have a calculation why that is, and below 25, which obviously you can see just below 25 over here is the actual level. So we send that out and say, okay, this is where you want to play it. This is what you do, and you keep that. You keep those positions. Okay, and then this way you know what you have. Now, we have a 30-day rule. You don't hold the stock more than 30 days and obey the stops and the profit levels. For example, we had Randgold Resources that we picked up. We were up 10% within about less than about a week or a week and a half. We took some off the table. We let it ride. And then if it comes down again, we'll actually move back into it. This is what an actual alert will look like. Very clean, very simple. We're always monitoring these. You don't get 5 a day, 10 a day. It's not how it works. We're looking for the most highest quality potential alerts so that you can actually find those fast zones that things are moving up with short interest on the upside. It's also breaking down alerts and bounce alerts and things like that. All right, let's see. Let's ask some questions real quick, and I want to show you something else. Anybody ask me a question, I am here. You just type it in the little chat box there, or the question box. You follow us on. We put we'll put that in the chat, Twitter. Okay, so you can just follow us at Trigger Trading. That doesn't give you all of the alerts; just gives you some of the public ones that are available. Okay. Does it work in? Okay, so let me just kind of go through here. What is your win-loss record? Well, it all depends. Right now, I think on a short-term basis, we're about 65%, 35% right now, and we put our track record up on the site. That's available for everybody to see. And right now, we've been a little bit more short, and that's been working out. And again, these are supposed to be short-term trades, less than 30 days. The goal is to find things that will break up or break down quickly. This is not just buy and hold something forever. If it doesn't work or it hits the stop or it hits the profit, we move out and move to the next trade. Does it work? We're getting on here. Let's see. Somebody asked, will you be using Twitter to notify members? No, we will not. Actually, we will not use Twitter. We use text messaging direct to you, and you get an email you get an email definitely, you get the site definitely, and you get a text message if you choose to use so. We cannot use Twitter and won't use Twitter. And the reason for that is that it's not secure. Let's see. I get the alerts. When I just see volume strikes and charts, I get confused with the institutions of volume. Okay. Yeah, so what's the problem? That's exactly why that's exactly why you want to use something that has a different way of looking at volume, because you want to find where the volume is at a certain price. It doesn't have to be one day. It has to be a culmination of all that. That's the important thing. Do we use? Yes, we use that as well. We use we use it. Well, of course, we do our own cooking. Somebody asked if we use it for our managed portfolios that we do internally. Of course, we do. Yes. I mean, we use other things as well, but we use the alerts. You'll see a lot of crossover in there. A couple of questions were about that. Does Horowitz Company Management use system internally? Yes, we do. Okay, that's the same one. Do you follow an alert with a signal to move out? I'm trying to follow all these. Let me just scroll up a little bit. Okay, hang on a second. Hold on. Don't go anywhere. Okay, hold on. Okay. Okay. The question is, do we follow an alert with a signal to move out, like when it's time to get out? And do we use options with these alerts? I mean, you can use options with these if you choose to. We're looking at just the stocks themselves at clear prices, but if you want to use it for options and use the price levels that we have for you, that's fine. It's a 30-day trade, so therefore, you can use that. Obviously, the differential is if you don't get to that price on the upside, the problem you have is the option expires worthless. So that's a big problem with that. It's a little bit of a different situation because there really isn't a volume strategy with options. There's another question of use it with other things. Yes, you can use it with commodities, currencies, stocks, bonds, whatever it is. These things are geared for that. Our partner with this, which is Task Research, Task Professional, they have some commodities they run with it. Actually, we're setting up a commodity strategy as well, so that we can kind of give you signals on strategies for that as well. Question is, do we provide the reports on your own stock choices? No. I mean, that's the problem is that we're trying to. We can tell you where these things are, but we can't just we're going to run your portfolio that way. That really wouldn't be the way. Somebody asked, can you see the boxes for intraday and take our own decisions? These boxes are available, by the way, intraday, any time frame that you look at. The algorithms are ours, so you're not necessarily going to be able to use it for your own. And if you want to buy it, they are available through like Bloomberg. If you have a Bloomberg terminal, and if that's, some of these are available. All right, let's take another question. Somebody asked me, what books do I recommend to learn general technical analysis? One of the best books, I think, is Brian Shannon's. Look up Brian Shannon. It's called I think it's called TechnicalAnalysisBook.com. Look up Brian Shannon, TechnicalAnalysisBook.com. It's just really great pictures. How much does what cost? Jose wants to know how much does it cost. How much does what cost? Yeah, Derek, you could use options. Again, we're not recommending that, but you could do that if you want. The other thing is there's a 14-day free trial. If you want to use the alerts, it's totally free, 14 days. Just go over to, very simple, I'm going to give you the actual place to go right now. Watch your, you'll probably get a follow-up email. Look in here, you'll see this is going to be, just go to TriggerPointResearch.com, subscribe, get 14 days free. Just put in your information. You don't have to pay for it, nothing like that. It's very easy. And you can get the professional pack, which includes the breaking up, breaking down, and the bounce alerts. You can get those for 14 days for free. It costs $99 a month for the breaking up, $99 a month for the breaking down, or you get a breaking down, breaking up, and bounce alerts for $179. It's pretty cheap. I mean, you'll make your money back, I think, if you follow this strategy. So we have some other things coming up. They're going to be a little bit more intense. Again, we just wanted to introduce you to some of this. We have the market trend indicator, because we have if you don't want to trade stocks, you want to trade more market trend, we have a really, really cool market trend indicator and market timing model that uses this and some other things to give you longer-term signals on, not years, but longer-term signals on actually when to move in the market, like if you want to use it for ETFs or options or just buying let's say a mutual fund, but market-based, not just stock-based, and it gives you a really good indication, like we showed you in that chart. Let's see here. All right, let's take a couple more questions. I'm going to close this. Let's see. How does it? This is part of the Techna process of the Quantum Fund Detector. Quantum Fund Detector is this is the technical side of things. This is one big piece of the technical where we want to look for stocks that are breaking out on good fundamentals. But again, this gives you both sides. It gives you we use it for technical based after the fundamentals, or you can just use it as a technical device on its own. And there's a couple more other questions here, and then we're going to close. I mean, Buffalo Wild Wing, yeah, we're holding on to it until we till we actually get out of the the position from above the box. When it's above the box, we're out. It runs up a couple of percent here or there, down a couple of percent here or there. It's okay. Does Eddie still run a chat room? I believe so. And somebody asked me something about Juan Villagias. He has something different, but he actually has a relationship with Task Professional, I believe as well. A little bit different than what we're doing. And somebody asked me about the prices. It's $99. It's all in there. Go over to where I told you that TriggerPointResearch.com, subscribe, and all the pricing is in there. Can I see the boxes day to day with my subscription to TPR? No, we're just going to give you alerts. This is only an alert system. And last question is, here's the last question. As a young investor, what's a good amount to implement in the strategy? Do you control the fundamentals before you alert? We have about a universe of about 350 stocks. We want to have more momentum-based stocks. That we have some other ones too, but we want momentum-based stocks that can move. How much you invest is all what you're comfortable with. I mean, we say probably about 10 positions max at a time if it gets to that point. So if you have $10,000, $1,000 each. If you have $100,000, $10,000 each, and about 10 positions maximum. If there are alerts on 10 positions within that period of time, are the maximum. Okay. What is the effect of everyone moving on the same? Well, hopefully not that much. We're not doing thinly traded stocks, Derek. So it's not going to be thin, and hopefully that's not going to really affect things. But we're aware of that, and we're careful about that. So that's that's something we do consider. All right, thanks so much. Listen, there's a quick survey and a thing coming up. Do me a favor, please take a moment and fill this out. We want to know how we're doing, and if you enjoyed it, how we can improve. That's important also, and I really appreciate it. Thanks so much.